A war starts somewhere in the world. You are thousands of miles away. You had nothing to do with it. You did not vote for it. You did not start it. And yet, your fuel costs more. Your groceries cost more. Your electricity bill goes up. Your savings lose value. Wars do not just destroy countries. Wars destroy economies. And economies affect every single one of us, whether we are paying attention or not. How does a war start affecting your wallet? Most people think war is something that happens far away, on screens, in headlines. Something that affects other people in other places. They are wrong. Every major conflict in modern history has reached into the wallets of ordinary people living thousands of miles from the battlefield. Not through bombs, through economics. Here is how it works. The modern global economy is deeply interconnected. Every country on Earth trades with other countries. Goods, energy, food, raw materials, technology. Everything flows across borders every single day. When a war breaks out, those flows get disrupted. Supply chains break. Trade routes close. Energy production gets threatened. Investors panic. And when global supply chains break, prices rise everywhere, for everyone. You did not start the war. You are paying for it anyway. Oil, the first domino. The single fastest way any conflict reaches your daily life is through oil. Oil is the lifeblood of the modern economy. It powers transport. It heats homes. It generates electricity. It is a raw material in plastics, medicines, and food packaging. Almost everything you buy has oil somewhere in its production or delivery chain. The Middle East sits on approximately 48% of the world's proven oil reserves. When conflict erupts in or near this region, markets react immediately, sometimes within hours. Traders and investors do not wait for actual oil supply to be disrupted. They anticipate disruption. They buy oil futures. Prices spike before a single barrel of oil has actually been affected. This is what we saw with Iran and the United States in 2026. The moment military action began, oil markets moved. Within days, fuel prices at pumps around the world reflected the conflict happening thousands of miles away. Higher oil prices mean higher transport costs. Higher transport costs mean everything. That moves, which is everything you buy, costs more to deliver. Supermarkets, shops, restaurants, every business that uses fuel, which is every business, passes those costs to you. The war did not touch your street, but it reached your supermarket within weeks. Inflation, the hidden tax of war. Wars cause inflation. Every single time, without exception in recorded history. There are three mechanisms. First, in supply disruption. When countries at war reduce their exports, global supply of goods decreases. When supply decreases and demand stays the same, prices rise. This is basic economics applied to a global catastrophe. Second, government spending. Wars are extraordinarily expensive. Modern military operations cost billions of dollars per day. Governments fund wars through borrowing and through printing money. When governments print money without creating equivalent economic value, currency loses purchasing power. This is monetary inflation, the same inflation we discussed in our previous video, but accelerated dramatically. Third, energy prices. As we covered, oil price spikes ripple through every sector of the economy simultaneously. Rising energy costs drive up the cost of manufacturing, distribution, heating, electricity. Everything becomes more expensive at once. The combination of these three forces creates what economists call wartime inflation. Prices rising rapidly, savings losing value, ordinary people getting poorer in real terms, even without losing a single job or seeing a single explosion. What happens to stock markets? When wars break out, stock markets panic, almost instantly. Investors hate uncertainty above everything else. War is the ultimate uncertainty. Nobody knows how long it will last. Nobody knows how far it will spread. Nobody knows which industries will be devastated and which will benefit. When uncertainty spikes, investors sell. They move money from stocks into what they call safe haven assets. Gold, government bonds, the Swiss franc, the US dollar. Stock markets fall. Pension funds lose value. Retirement savings shrink. Ordinary investors watch their portfolios drop, caused by a conflict they had no part in starting. But here is something most financial news does not tell you. Not all stocks fall during wars. Some rise dramatically. Defense companies, arms manufacturers, energy producers, private military contractors. These sectors frequently see their stock prices surge during conflicts. Someone profits from every war. It is rarely the ordinary person. It is rarely the soldier. It is the shareholder of the company selling the weapons, the investor in the oil company whose prices just doubled. Wars transfer wealth from the many to the few, from ordinary people through rising prices and falling portfolios to specific industries that benefit from conflict. The sanctions economy. Modern wars are not just fought with weapons. They are fought with economic sanctions. Sanctions are economic penalties imposed by one country or group of countries against another. Trade bans, asset freezes, banking restrictions, travel bans on individuals. The theory is that economic pain will force governments to change their behavior. The reality is more complicated. When the United States and its allies impose sanctions on a country like Iran, they cut off that country from global financial systems. Iranian banks cannot process international payments. Iranian businesses cannot access global markets. Iranian oil cannot be sold freely on international exchanges. This causes severe economic damage inside Iran. Currency collapses. Inflation explodes. Ordinary citizens lose purchasing power rapidly. But sanctions also have unintended consequences for the countries imposing them. When Iranian oil is removed from global markets, global supply decreases. Prices rise. American consumers pay more at the pump. European households pay more for heating. The economic weapon cuts in both directions. And sanctioned countries do not simply collapse. They adapt. They find alternative trading partners. They build parallel financial systems. China, Russia, other countries willing to trade outside Western financial structures. The world gradually splits into competing economic blocs, each with their own rules, their own currencies, their own trade networks. This fragmentation makes global trade less efficient. Less efficient trade means higher prices. For everyone. Everywhere. Food. The forgotten front. Wars do not just disrupt energy. They disrupt food. Ukraine and Russia together supplied approximately 30% of the world's wheat exports before 2022. When war disrupted that supply, bread prices rose across Africa, Asia, and the Middle East. Countries that had nothing to do with the conflict found their populations facing food insecurity because of it. The Iran and United States conflict of 2026 created similar ripple effects. Iran sits at the mouth of the Strait of Hormuz, through which approximately 20% of global oil trade passes every day. Disruption to this strait threatens not just oil, but the entire supply chain of everything that oil enables. Fertilizer production, food transportation, refrigeration, processing. Every step of getting food from a farm to your table involves energy. When energy gets disrupted, the entire food supply chain becomes more expensive. Wars make food more expensive for people who did not plant the fields, did not fight the battles, did not make the decisions. The cost of conflict falls on everyone, equally, regardless of their involvement. What happens to your currency? Wars affect currencies in ways most ordinary people never track, but feel immediately. When a country goes to war, or when global stability is threatened, investors rush to currencies seen as safe. Historically, the US dollar, the Swiss franc, gold. This rush to safety strengthens the dollar and weakens almost every other currency simultaneously. When your local currency weakens against the dollar, imports become more expensive. Since most countries import significant amounts of food, fuel, electronics, and medicines priced in dollars, a weaker currency means immediate price rises on essential goods. Countries with weaker currencies feel the impact of wars they did not fight more severely than those with stronger currencies. A conflict between two distant powers can devastate the purchasing power of a population on a different continent entirely. Currency weakness also increases the cost of national debt. Many developing countries borrow in dollars. When the dollar strengthens and their currency weakens, the real cost of repaying that debt increases. Government budgets get squeezed. Public services get cut. Ordinary people pay the price. How to protect yourself. You cannot stop wars. You cannot control oil markets. You cannot redirect the decisions of governments and military commanders. But you can make decisions that reduce how much any global conflict damages your own financial situation. First, diversify your income and investments. A single income source or single currency concentration makes you extremely vulnerable to geopolitical shocks. Multiple income streams, international investments, reduced exposure to any single economy or currency. Second, build an emergency fund. Wars create sudden economic shocks, job losses, Price spikes. Supply shortages. Having 3 to 6 months of essential expenses saved as cash provides genuine protection when economies become unstable. Third, reduce debt aggressively during stable periods. Interest rates rise during inflationary periods caused by conflict. High debt becomes dramatically more expensive when central banks raise rates to fight wartime inflation. Less debt equals less vulnerability. Fourth, understand that gold and commodities historically hold value during wartime inflation better than cash, not as speculation, as insurance against the currency devaluation that wars typically cause. Fifth, pay attention to what is happening in the world, not to create anxiety, but because global events have real financial consequences. Understanding the mechanism, oil to transport to food prices, helps you anticipate and prepare rather than react and panic. Wars are not abstract events on distant screens. They are economic forces that reach into your home through your energy bill, your grocery receipt, your salary, your savings. Understanding how they work is the first step to protecting yourself from their effects. Let us bring everything together. Wars destroy economies through interconnected mechanisms. Oil price shocks ripple through every sector simultaneously. Wartime government spending and money printing create severe inflation. Stock markets panic, transferring wealth from ordinary investors to specific industries. Sanctions create economic damage that spreads beyond their intended targets. Food supply chains get disrupted for populations with no connection to the conflict. Currencies weaken, making imports more expensive for everyone. You did not start the war, but the war will find your wallet. The best protection is knowledge, diversification, an emergency fund, reduced debt, and understanding that the global economy connects all of us, whether we choose to be connected or not. This is not financial advice. Please consult a qualified financial professional before making any investment decisions. Check out other Broke Monkey videos for more financial topics explained simply and clearly. If you want to support this channel so we can keep making these videos, check out the link below. Apes Together Strong.